Are you looking to build sustainable or significant wealth? Every single person on this planet would love to earn passive income so they can spend their time as they want. If you have $100,000 to invest at a young age, let me tell you that it's an awesome start. So how much dividend you'll generate from this much capital? Will that be enough to pay your regular expenses, such as your grocery bills, your car fuel, and your rent? Well, this dividend amount will be enough to give peace of mind to see the regular flow of income in your bank. Hello guys, welcome back to Money Invests. In this video, I'm going to tell you how much dividend you will end up receiving by investing $100,000. Well, this dividend amount will be enough to give peace of mind to see the regular flow of income in your bank. If you want to earn a stable dividend income by investing $100,000, then smash that like button for good luck. I really appreciate it. If you have a question in mind about how much money as a dividend you will receive from this $100,000, then it really depends on where you have invested your capital. For instance, you could have invested in a general board market index fund that will trail the whole S&P 500. You can purchase single dividend stocks to maximize the growth in your income. Or you can also have the option to purchase a blend of both. Dividend income will also fluctuate based on the fierceness of your portfolio and will also depend on how much time has left for your retirement. You don't want to invest only in income investments way before your predictable retirement date, simply because overall returns are lower with dividend-paying stocks. This is because they are not very fast-growing companies, but rather old blue-chip replacements. High income is enjoyable to have, but it eventually is unrelated to newer investors. If you want to get the blend of both growth rate and dividend income, if you put all your $100,000 into a fund that tracks the S&P 500, then you can anticipate an average amount of dividend income, means that it won't be geared towards income or growth but a blend. Since you're purchasing the market, your income and overall returns, including capital gratitude, will be average. So far, the S&P 500 has a dividend income of approximately 1.5%. So what does that mean? It means that you will receive an amount of $1,500 annually or $125 every month. Normally, payments are made on a quarterly basis, so you will receive $375 each quarter. However, the dividend amount is not so high that you can make your living on it. The overall return is almost 10% yearly. Getting this type of dividend income is good for a normal investor. The reason behind this is it provides a perfect combination of income and also growth. Even if someone spends the total of their dividend payments, they would still see substantial investment growth over time. If you want to focus on growth rate instead of dividend income, to achieve a higher growth rate but lower dividend income, one might choose to invest in an S&P 500 growth fund. A growth fund, just like this, would hold the fastest growing companies that are held within the S&P 500. This is ideal for people who don't strategize on retiring for quite some time and don't depend on their dividends. Their return will possibly be 0.5% because the majority of the holding companies are tech-related corporations which pay little to no dividends. With this percentage, it means that you will only receive $500 annually or $41 per month by investing $100,000. There's no doubt that this return is minor, but the capital increase with a higher than average since the companies are fast-growing businesses. Tech companies including Nvidia, Microsoft, and Google. These type of companies give minor amounts of dividends due to the reason that they like to grow the business instead of just distributing income to shareholders. Since the dividend income is only 1/3 of the S&P 500, you'll need 3 times the capital invested in receiving the same amount of return. Since the growth rate is very high, you could reach the number rapidly. Most people who want to reach this growth rate rapidly, they smash the subscribe button for good luck. Now let's discuss what should you do if your focus is on higher dividend income instead of growth rate. If you want to get a higher dividend income and don't bother to get a lower rate or return, you can also think about buying a fund that is designed to particularly give higher than average dividend yield. A perfect example of this type of fund is SPDR'S S&P 500 High Dividend ETF. It owns companies that have the highest dividend yields that are included in the S&P 500. These funds are mostly sluggish in capital appreciation because companies focus on producing reliable profits and income from shareholders instead of trying to grow. Keep in mind that even when considering the dividend payments, returns will likely be lower than a higher growth substitute. That's why this type of investment is usually suggested to those who want to get the retirement income instantly and don't have the patience to see their investments grow gradually before getting the return. Some investors prefer to buy single dividend stocks that meet this criteria. Every person has their own predilections in terms of features of stock. But dividend investors usually seek those with a history of dividend growth. They also want future dividend growth in addition to a company with growing earnings and profit to ensure their price of a share will also increase. A dividend stock that yields 10% but loses 20% of its price of share per year is not a good investment, but many beginner investments are enticed in by an extremely high yield. Single dividend stock. Single stocks are the riskier option, but they also allow for the most upside. Since share prices move independently, it's easy to spot a specific stock that is on sale for various reasons. On the other side, some stocks are equally overpriced. It's hard to get a deal when buying funds because all the stocks are priced together. The ability to buy a single stock on sale is what is most tempting to investors. Think of it like buying a fixer-upper that's priced way lower than the market value with massive upside. It's easy to grab that rundown home on sale, while the immaculate property on the other side of town is priced at a premium. One example of a single dividend stock is Iron Mountain. Their business is storing, protecting, and managing information and assets. It's one of the highest yielding stocks in the S&P 500 due to the fact that it's a REIT, which is typically the type of stock with the highest yield. On average, it pays a 7% dividend, which means that you'll receive an amount of $7,000 yearly or $580 per month as a dividend. That's a good amount, and I hope that the share price will also increase in the future. Its earnings don't grow that much as compared to its peers, but the dividend income is why most would own it. It's not suggested you mount your entire portfolio into one single holding. Iron Mountain is a good example of what you could potentially purchase and receive a good income for doing nothing. Further, if you have a portfolio consisting of 10 quality stocks, the chances of one of them being on sale at any given time are high. So you must always get a good deal. The amount of dividend income produced from a portfolio from this investment is not exactly a hefty amount of money. There's no doubt that some people don't want just this amount of money joined with other sources of earnings, such as part-time business or Social Security income. According to the data, the average amount of Social Security benefits is almost $1,500 a month, which is good. A couple whose monthly expense is not much can live their life happily on this amount, in addition to the dividend income as well. If a retired person is also working part-time and getting almost $1,200 per month, then the addition of dividend income will be a great idea. There's no doubt that the amount of dividend income is not so big, but the power of these dividends reinvested over time will be enormous. Many young investors are taking interest in dividend stocks, but they should keep in mind their goals and how they're going to get them. I know for a fact that you are smart because you're still watching this video. So what advice would you recommend? Share your thoughts with us in the comments section below, and while you're there, click the subscribe button for good luck.